Working hard, saving a little and leading a good life. Is that enough to make you crores? No, not if you don't have a big ticket job or a whopper of a business. Surprisingly though, it doesn't take a whole lot of earnings to reach those crores. You simply have to plan and invest regularly, invest smart. So, let's talk money and help make that happen for you. My expert panel today, Amit Kukreja, certified financial planner, and of course, Harsh Rungta, CEO apnapaisa.com. All of you know him very well. Gentlemen, thanks very much for joining me. Harsh, let's start the discussion today with the freeing up of savings rate by banks. You know, when it comes to money and regulation, I can see so much good happening. ULIPs, they've got better, charges have come down, mutual fund entry loads have gone, and now saving rates have got freed. So much good happening for the customer, all for the better. And banks now queuing up. I mean, the new private sector banks are all queuing up to offer higher rates.
I think, Manisha, you can call this the charge of the regulatory brigade. I mean, I think over these last 2 years, we have seen huge changes in regulation that clearly are pro-consumers, as you mentioned, whether it was the ULIPs or now savings bank deregulation, abolition of prepayment charges, prospective as far as banks are concerned, already done for the housing finance companies, the whole lot. But if we talk of just the savings bank deregulation, it will mean a whole lot for the banks. I don't know how much it will mean for the consumers, because typically you would expect, say, the rate to go up a percentage or a percentage and a half. The larger banks are unlikely to increase it to 5.5, 6 that a Kotak or the Yes banks have done. Clearly, I mean, there are roughly about 15 lakh crores of savings bank savings in the country. Even a 1 percentage point on that additional interest paid has a huge impact on the bottom line of the banks. But if you look at it from the consumer side, really the people who will benefit are the lazy investors, and it may not really mean all that much to them. I think the bigger benefit really the consumers who are aware anyway don't keep too much money in their savings bank accounts. I think it's a great step, and it will put pressure on the banks to make be far more efficient. And I think the flip side of this regulation we will see in the times to come, which will be, now there will be charges that customers will have to get used to paying. There was this unwritten contract between the customer and the banks that you pay me low on my savings bank accounts, but don't charge me for all the services that you give. I think that's about to change. So I think we are yet to see the sting in the tail.
All right, we yet to see the sting of that move, but it is really a big bonanza for lazy investors. We are hoping that as a Let's Talk Money viewer, you're not lazy and you don't leave around too much money in your savings account. Very interesting question, Amit, from Satya Brahmachari from Bangalore. He says, he says that are savings bank interest rates taxable or non-taxable? But more importantly, interesting, because I'm sure a lot of people also have this question. There's a notion that if I book fixed deposits in different branches of the same bank, I will be able to save taxes that TDS is calculated on the branch code itself. Correct me if I'm wrong.
Sure. I mean, savings rate, the interest earned on the savings account has always been taxable. I don't know why he thinks it was never taxable. Even if when it was 4%, it was taxable.
Right.
Now, coming back to the other question of having fixed deposits in the same bank at the same branches, you can avoid TDS if your interest earned is less than 10,000 on the entire FD amount. So be it across branches, be it across the banks, there is no back-end verification of a specific PAN, you know, for which they figure out that TDS should be deducted. If you have TDS less than 10,000, it won't be. If the interest earned is less than 10,000, the TDS will not be deducted. But be a good citizen. When you file your tax return, put the entire interest amount earned under income from other sources and file your tax returns for that.
All right, so you can do it. So
Absolutely.
It's possible to book FDs or have different savings accounts, but if it's exceeding 10,000, you anyway have to report. Sure. And you will be getting taxed. If it's not, there won't be a TDS, but you still have to report that income, isn't it?
Absolutely.
All right, let's on that note welcome our first caller who wants to know whether he's on the right track. Prakash Nair, 37, calls in from Assam. Prakash, where in Assam are you?
Hi Manisha, we are located in Jorhat, Assam.
Okay, all right. And your wife is in armed forces. You must be very proud of her.
Yeah. On behalf of her, I am asking the query because she went for a TD.
Great. Lovely pictures you've shared of Sheila, kids and yourself. Blessed with a lovely family. Go ahead. Both of you seem to be saving a substantial amount of your earnings as well. How can we help you?
Well, Manisha, I worked in the Middle East for 10 years and all my savings put into property and agricultural land. My wife is working in the army and she completed 14 years of service and we have 2 kids aged 7 and 5.
Okay.
I think I have sent you the details of my portfolio.
Yes.
Most of my savings in property and agricultural land, and after watching your program, some in mutual funds and stocks.
Okay.
Now my wife is targeting for a premature retirement after 67 years. And I would like to know whether her pension, our investment in land, rental income is good enough to meet our future requirements of settling my children and living comfortably.
Okay, long question, but you also have a lot of savings. A lot of it is locked up in land, and you have the right question. How much more should you be investing in mutual funds and stocks? Because there's a clear gap there, Amit, in his portfolio.
Sure.
There are some loans as well, but look at the amount. I mean, it's a very decent savings portfolio to have at the current age that they are at.
Sure, absolutely. I mean, as you said, his portfolio is, Prakash, your portfolio is heavily skewed towards real estate investments. So, and I think it will be a good move to start diversifying your portfolio and move into equities through mutual funds, though. As I understand from the email, this is just going to be the beginning of your equity investment. So my recommendation would be not to go into equities directly, but through the route of mutual funds. And I think you should pay off your debts definitely first, especially the car loan that you have must be paid off first, then the high interest gold loan, and then subsequently the relatively lesser rate of interest gold loan that you have. The biggest question I think you have that I understood from your email is how to arrange the funds to pay off these debts. And I think my recommendation would be to either go the loan against property route, not the loan of housing improvement, because if you take the loan against house improvement, you have to use it for that purpose. You cannot use it for paying off other debts, especially if you want the tax advantages. So I think pay off your car loan and pay off your gold loan, either by taking a loan against property or selling off one of the properties. You seem to be having a long list of properties, and I'm happy that they've worked out very well for you. Just liquidating one of them and then using that as an opportunity to pay off your debts as well as enter the equity markets through mutual funds will be a very good move for your portfolio.
Absolutely. I think some property, and you know, when I see so much of agricultural property, it appreciates fabulously well on paper. There is a lot of appreciation in land in this country, but remember, when you actually try and sell it at the time of the requirement for money, land tends to get extremely lumpy. When you want to sell it, suddenly buyers disappear from the market. It can get very lumpy and very, very sticky, isn't it, Harshan? That's your concern as well in Prakash's portfolio.
Absolutely. I think there are several positives. I mean, their expense to income ratio is an extremely low 30%. Very high exposure to gold, extremely high exposure to agricultural land, that too in a concentrated geography in and around their hometown in Kerala. I think I would go a lot further than what Amit has said. No loans, Mr. Nair. Please sell off almost all your properties except maybe retain one. Sell off worth about 75 lakhs. Pay off all your loans. I think Mr. Nair mentioned about buying a residential house for own stay. Buy that now. Sell off the land and buy that house for your own stay. Stay debt free. You are well on your way. She will get a pension. Our understanding is the pension, which is also partially inflation indexed, and some of the other assets that she has is enough for retirement. The money that they have from the Army Group Insurance Fund and the DSOP fund that they have, that when it matures after 6 or 7 years, when she retires, even if that she puts in a balanced fund, I think that is more. And the value of gold, I think she has about 11-12 lakhs of gold. I think all that put together is enough for the children's marriage expenses or the children's expenses that they have budgeted for, and clearly start getting into equity very quickly through a systematic investment route. Go for the build a core portfolio, go for the top funds, blue chip funds right now.
Right.
To start with. I think they are on a good wicket. They need to get out of this overexposure to land and borrowing. They just don't need to borrow.
There you go, Major Sheila and Mr. Prakash Nair. Good wicket, good amount of savings. Please diversify into equity funds. When we say build a core portfolio of mutual funds, very easy way to actually spot them. Morningstar Value Research, two websites which actually tell you how the funds are rated on their performance. So go ahead, pick out some top line diversified and large cap funds. Names which come to my mind automatically are HDFC Top 200. You also have ICICI Prudential Focus Blue Chip. There are some mid cap funds which are very good, but we'll come to that at a second stage. Right now, just stick to some large, well diversified funds and large cap funds, and aggressively start investing in equity funds. If you want to have a fantastically wealthy retirement, you have a comfortable retirement, we are talking about a wealthy retirement. Next up, we've got Sunil Kumar joining us from Mysore. Hi Sunil, go ahead. What's your question?
Yeah, just I have actually made my distinct portfolio.
Yes.
Right now I am into ICICI Prudential Focus Blue Chip mutual fund, then HDFC Prudence and Franklin Blue Chip.
Right.
And just I wanted to know, like I want to add on the gold savings fund. In that I want to know which one is the better. I think in market right now there are 3 or 4 gold saving funds.
Right. Okay.
And also, like, is it wise to get into any of the mid cap this thing like IDFC Premier Equity?
Okay. All right. And we'll also weigh out for you gold versus a gold fund versus a mid cap fund, or should you just put a little bit in both or split whatever extra you have. Your core fund portfolio is very good. ICICI Focus Blue Chip, Franklin Templeton Blue Chip and HDFC Prudence. Within gold funds, Harsh, you've always maintained there's not much to choose from, is there?
Oh, absolutely. I mean, a gold fund just invests in the physical gold. Go for an ETF if you have the discipline to be able to do that on a monthly basis. Very few investors have it. And therefore, maybe you go for a fund that invests in the ETF of the same fund house. So you have a Reliance Gold fund that invests in Reliance Gold ETF. You have an SBI Gold fund that invests in SBI Gold ETF. You have another one as well. I think I would recommend SBI Gold. Simply, there isn't a track record, but the expense ratio is very low, and I think that's what really matters as far as the gold fund is concerned. I would put that not more than 10% of your portfolio, that too if you are having a long-term view, should be put in a gold fund. And definitely a small amount should also be looked at on mid-cap once you have got your core portfolio created. And IDFC Premier Equity is an excellent choice for mid-cap. But I would also suggest, please, I think investment and protection goes hand in hand. We've seen a lot of investors talk here about their investments, but really I think people think protection is a waste of money. We don't know about this individual, but basically please also look at your protection requirements because that can make your plans go completely awry, whether it is life insurance or health insurance.
A slight detour here to talk about the new global indices trade introduced by the National Stock Exchange. NSE has started trading in S&P and Dow futures. Both are US market indices and capture the US economy and corporates. S&P focuses on the large cap segment of the US market and covers around 75% of the US equity. And Dow Jones Industrial average that includes 30 most liquid blue chip companies in the United States and represents around 28% of the float adjusted market cap of the US stock market. We are now joined by Craig Lazara. He is the Senior Director, S&P US Equities. He joins us from Chicago on the phone line to just run us through the rationale of introducing these indices on an Indian exchange. Craig, thanks so much for joining me. Let me start with why India and why NSE?
Well, there were, I guess, a couple of things to say about that. One is that we have had for a number of years a very fruitful and good relationship with the National Stock Exchange. So whenever you contemplate as an index provider doing something, away from your home market, obviously you need a strong local partner, and we have that, and do have now have that in the NSE. So that's the first thing. The second thing to say, I suppose, is that we thought that the listing of S&P futures and options would give Indian investors a number of ways to either to hedge exposure to the U.S. equity market if they have exposure now, or to take on exposure to the U.S. equity market if they want to take exposure on. So as the Indian investment community becomes more outward looking, we thought these vehicles would give them a very efficient way to gain access to the largest market in the world.
Okay. My next question, rupee denomination or local currency, this is a first for S&P. And why did you take that step?
It is, yes. We're very, very pleased about that. The thought we had was, and I think we owe this as much to the NSE as to ourselves to give credit where it's due. The thought we had was that by denominating the contracts in Indian rupees, it would be possible for Indian investors to have access to the U.S. market without the necessity of taking currency risk. I mean, typically, as I'm sure you know, an investor wants to invest offshore. He has to, first of all, change rupees into the currency of the local market, make the investment in the local market. When the time comes to liquidate, you sell in the local market, then convert back to rupees. So there are really two elements of the return: the rupee move, and relative to in this case, to the dollar, and the move in the market that you have in mind. To the degree that investors are in India are interested in investing in the U.S. or hedging in the U.S., not because they have a currency view, but simply because they want access to the U.S. market, this gives them a more efficient way to get that without having to worry about the currency moves in the meantime. So we thought it was a more direct way for investors to get what they wanted without having to assume the risk that they didn't want.
How has the trade response been so far?
It's been quite good. I can't give you the most up-to-date figures because I haven't followed them last week, for example, although the NSE certainly could. I know that when I was in India a few weeks ago and meeting people in conjunction with the NSE, the volumes were quite strong, and the NSE was very pleased. So we're quite happy with the way the launch has gone.
Craig, thanks very much for that explanation. Happy to have you here on the show with us. Next up, our insurance segment. Be sure when you insure, we'll get the best health insurance options for you. Also, why don't you use the ad breaks to send us your money questions for the best expert advice? The contact details are flashing on your screen. You're watching Let's Talk Money, the show that gets you to fix your money, life, and when you're talking about fixing money, life insurance is the most critical step to financial security, be it life or health insurance. Suresh Veluru joins in from Bangalore with a health insurance question. Suresh, your pictures, where are they taken? Is it Lal Bagh Botanical Garden?
No, it's some other park.
Okay, all right. But I saw a lot of green and I really love that park, so I thought probably it's from there. Go ahead. What's your question?
Currently, my employer provides insurance for me and my parents.
Mm-hmm.
But I'm actually looking at taking health insurance outside of my employer from
Okay.
private insurance players. Now, I'm a little confused because I'm looking at pure health insurance cover.
Mm-hmm.
And then LIC offers one policy called LIC Jeevan Arogya.
Okay.
It is a fixed benefit plan, not as per expenses. So I'm confused which one to take.
Should you take a health insurance policy from a life insurance provider? I think, Harsh, that's a big question to talk about as well.
Okay, so I think the real question is, what is the difference between this specific policy that LIC is offering called Jeevan Arogya as compared to, say, a regular hospitalization expense reimbursement policies that various non-life companies offer. I think the policies are completely different. The Jeevan Arogya policy essentially is a allowance policy, in the sense that it does not look at actual expenditures. So there would be, for example, for every day spent in hospital, there would be a certain daily allowance, $1,000, 2,000, 3,000, depending on the premium that you choose. Or there could be a major surgical benefit. For specific kinds of surgeries, you would get a lump sum payment irrespective of what you incur. It has got nothing to do with the actual expenditure you incur. Now, these kind of policies are good as add-on policies. Remember, there are a host of reasons why you can get into a hospital. It may not be due to surgery, and those could be very, very expensive, and they are not going to be covered. The expenses are not going to be covered by a policy like the one that you have spoken about, Jeevan Arogya. So you definitely need a hospital expenses reimbursement policy. Essentially, in popular parlance, it's called Mediclaim. That you definitely need, and I think it's great that you are looking at taking this policy in spite of your employer having a policy for yourself, your family, and your parents as well. And I think that is a must, simply because the employer may discontinue policies. Group policies are becoming extremely expensive, so increasingly they are getting discontinued, or the benefits are getting reduced, or co-pays are being introduced, etc., etc. Plus, of course, if you decide to change employers, the new employer may not have a policy. So definitely you should look at your own policy from non-life companies. We have given certain suggestions. I think for the ages that you have mentioned, we would suggest you do two things. One, you take individual policies of 3 lakhs each for yourself and your father and mother, and then take a top-up policy or a super top-up policy with an initial limit of 3 lakhs. I mean, both of them put together, 3 lakhs of individual policies and 7 lakhs of super top policy for each of the three of you, I think totally costs you about 27,000 rupees. Those are some of the, I mean, we have recommended Apollo and ICICI Lombard and Oriental, as well as United India. You can have a look. I think they are flashing on your screen. But please go ahead and do this as quickly as possible.
All right. So that's the big question. Should you be taking a policy from a life insurance company? There's no harm in it. Jeevan Arogya is a good policy, but it isn't really a substitute to having a full medical or health cover from a general insurance or a health insurance company. Gentlemen, thanks very much for joining in for this show and for your expert advice. Amit, pleasure to have you. Harsh, always a pleasure to have you here on Let's Talk Money. Just a quick reminder, you can send us your questions via SMS, and the number to send it to is 56388. Just write money question and 56388. Dial in, and the number is 416-35871, preceded with 011. Email, that's the easiest way to reach us with all your details, portfolio, your life history, your pictures, and we love to get it all. money@ndtv.com. Follow us on ndtv.com/Let's Talk Money. You can watch our existing episode, facebook.com/Let's Talk Money, and twitter/MoneyNDTV. Those are some of the URLs that you can be with us on. We leave you with this signage, which we thought really is appropriate in the current environment. Basically, Diapers and politicians should be changed very often for the same reason. Thank you so much for joining in and see you again next week. Goodbye.